Good morning, and thanks for joining us here on Treasure Coast Solutions. Wednesday mornings from 9 to 10 o'clock, we talk about some of the things that might impact you in your daily lives, some of the economic and financial issues that might be pressing on you or might cause you some concern, or maybe to take advantage of an opportunity coming up. Again, it's not a financial planning show, so I don't generally talk about that kind of thing. We don't talk about issues like what should I do with my retirement money and all of that. That's not something that we're normally focused on. More of a general discussion of economics from a broad sense, and what happens and doesn't happen, and what will happen and won't happen. My name is Mark Breckbill. I'm a CPA. I'm also a ex-banker and had been chief financial officer of about $1 billion bank at one point. So I've kind of had an opportunity in my lifetime, and I do consider it an opportunity to see some different things. The one good thing about banking is that you're usually cutting edge on some things that are happening financially. Some people refer to it as bleeding edge, and it can be. But it is an opportunity to kind of be out front on some issues and see what's happening. And it's also a good opportunity to, especially if you're from a finance background, it's a good opportunity to get an understanding of economics. I know one of the things that was a general routine for me on a regular basis when I was working in the banking industry was coming up with an annual budget and determining what we were going to do. And for a bank, interest rates make a big difference as to profitability. You would think that if interest rates go up, banks make more money, and if interest rates go down, they make less money. That's not actually true necessarily. There's many times when depending upon what kind of things the bank has done, that they're impacted by the opposite situation. So if interest rates go down, they could actually lose money, particularly when interest rates get as low as they are today. So it was an opportunity. One of the things when you're doing budgeting is in a bigger bank is usually either have an economist or you're relying on national economists that you work with to provide you with forecasts. And we used to do that on a regular basis. So it's kind of interesting to see where we are. And I'm spending a little time on that scenario and banks and interest rates because I think it's something that we have to be concerned about going forward. And that's why I'm discussing it. And I'm going to, I'm not going to ignore the elephant or the donkey in the room because we have had an election. We don't know the results yet. Chances are we won't know a lot of the results necessarily very quickly. Although I understand that Pennsylvania, which may be take the longest to decide. By the way, from those of you that are from Pennsylvania, now you get to be the butt of the joke. Those of us from Florida, we've had our opportunity. We're passing it along to our friends in Pennsylvania, but anyway, it looks like Pennsylvania may be the last to count, and may take the longest. But it may be that they don't make a difference. A lot of it's going to depend on what happens in some of these key states still for Biden or for Trump, particularly Michigan and Wisconsin, North Carolina, and Nevada. And it's unbelievable that Nevada could actually make a significant difference based on where the numbers are. Depending on the scenarios, Trump could end up 2 votes short or not, and a lot of that has to do with and Biden could end up just making it without Pennsylvania if he gets Nevada. So it's kind of funny that the numbers are that tight and are that close. But so that's kind of where we're at right now, election wise. We'll keep an eye on it during the show, and if there's anything going on, we'll try to bring you an update just to keep you informed because it is going to make a difference. And that's where I wanted to go today a little bit as far as where we're at. Hopefully, none of you made any significant financial decisions based on your guesstimate of the outcome of the election, because if you did, that was not something that was a wise financial move. And I said I don't usually deal with financial planning, but I do it, and I do a lot of financial planning, and I can tell you this: uh, financial investments are long-term investments, and they certainly, in the short run, will be swayed by variations in who's in office and where interest rates are and things like that in the short run. But in the long run, they're in the long run, you're looking at more stability particularly in equities. Um, but I'm reminded of the fact that many people in the last recession lost way more than the market ever dropped. I don't remember the numbers now. I used to am committed to memory, but I think that in the last drop, the markets dropped a total of about 20%. Was what happened. 25% was their biggest drop. Yet people lost 50 and 60%. You say, well, how can you lose 50 or 60% if the market only drops 20% or 25%? Well, it's very easy. The market drops, the market drops 15%, and you get out because you're convinced that, well, I'll just wait. I can't go any more than this. I can't afford to lose more than 15%. And you'll just wait until the market starts going back in, and then you'll get in. Well, that timing is impossible. If you knew how to do that, you wouldn't be doing this. You'd be doing something else, because you'd be making billions of dollars if you could time the market like that. And you can't. Even Buffett does. He doesn't time the market at all. He buys undervalued assets, converts them and changes them either through marketing or through operational adjustments, and then turns around and gets rid of them. Most of the time, though, he holds them for a long period of time because he's looking to stabilize or take over an industry. He's looking to get a dominant position in an industry. So that's the same thing for you as an investor. You're not gonna be able to time the market. But anyway, the market drops 15%. You get out. The market starts creeping up. It goes up 5%. You jump in because you say, now I'm gonna get in and ride it back up again. And you jump in, and it goes up. It goes up another couple percent, and then all of a sudden it crashes and goes down now another 10%. So basically we're down about 18 or 20%, and you've already lost 25%. And so that happens multiple times. You jump in, you miss the turn, and the average person I don't care how good your broker is, they don't know the turn either. I don't care how good their back office is, they don't know the turn either. If they did, they would not be fooling with you. I guarantee you that all of the brokerage firms in the world would not deal with one consumer if they knew the exact timing of the market. The reason they deal with consumers is they don't, and you as a consumer are their opportunity to unload the mistakes they made. And that's frankly, that's it in a nutshell when it comes to that. And am I critical of the large investment firms? Yes, very critical of them. Am I critical of the people that work for them? No, they're just doing their job. They're doing what they're being advised and told. They believe their employer. They truly believe that some of this stuff is true. But I can tell you from back office scenarios, that ain't the way it works. The way it works is that the average consumer is there so that when you buy something that doesn't make any sense, you can get rid of it. And that's what historically has happened. Why do you think it is that most initial public offerings, IPOs, that are popular go to a handful of people that are favored by the brokers, because they know that there's almost always going to be some sort of bump there. And then who gets those securities when that bump has taken place? Well, then that goes to the consumer base, right? You don't buy it on the IPO, you get to buy it in the market. Well, what usually happens there? Well, a lot of times you lose your rear. Sometimes, maybe not. but a lot of times it costs you a lot of money. And so therefore, it's one of those kind of things where, it's tough. To be to be a consumer. I don't care how big your portfolio is. Now, I will say, if you get the size of Buffett, you probably get some, there's probably some concessions, but they bypass that. They do all this stuff on their own, so they don't have to deal with the market and the average consumer. It's the same thing right now in the financial markets. A lot of the financial markets right now are controlled by hedge funds, and it's a good thing because hedge funds do provide some competition, but hedge funds wouldn't exist right now as a source of capital if it weren't for the fact that the banks were protected from failing and have done such a poor job in terms of managing assets. And I understand, especially in the area of the consumer banks and the local banks. The local banks are, they've been put in a position where they can't win. They have to do business with local customers. Their local customers are not big, so the government doesn't care if their local customers go out of business. Thus, they go out of business, and so there's no protection for that small community bank. And that small community banks, all those small community banks have rapidly become big community banks or big banks in total, and they're not there to serve that market any longer. It doesn't make sense for them to serve that market, and they're not protected if they serve that market. So if I'm a local community bank, I am going to as rapidly as possible, get to a point where I'm going to try to be loaning money in Orlando, to loaning money in Tampa, loaning money in Jacksonville. Why? Because I've already got the local market here. It's already a large portion of my portfolio. So if something happens in Stuart, it's going to affect me more than my competition. And that's going to put me at a disadvantage with my competition, which is going to put me out of business. It also is going to make it harder to sell. If I own 80% of the Stuart market and somebody's looking to buy me, the most they're going to probably get is 20%, right? I mean, that's their upside, 20%. But if I own 30% of the Stuart market, now the upside's pretty good. Now, if I'm another bank, I don't have to get the whole market. If I get another 10 or 15 or 20%, and I get up around 40 to 45 to 50, I've got pretty good control over the market. I'll be able to protect myself, and I'll have an opportunity to take advantage of that market and make a profit. And at that rate, maybe even make a unfair profit under economic terms. But so that's and that's kind of what we've seen happen, and that's what we are seeing happen. And in the old days, and I'm talking 15, 20 years ago, there would be new banks that would start. That was the fail-safe. So when the big banks or the bigger community banks became regional banks or sold out, there would be a small community bank that would shoot up. But nowadays, it's almost impossible to get that done. It takes millions and millions of dollars of capital, probably 15, 20, 25, $30 million to start a small community bank. That's as big as the community in most cases. And the return is not that good. Frankly, a bank investment on a startup bank is not that good. They sometimes fail. They don't produce the results. They take more capital to get bigger, and the return on investment is poor. It used to be that it was considered a safe investment, but it's not even considered a safe investment now because many of those small community banks were allowed to fail instead of being protected. And that's what I'm saying. If they should have protected anybody in the 2008, 2009, 2010 crash, they should have protected the community bank. Instead, they protected the large money center banks, which have all kinds of opportunities in terms of what they're going to do with their money, including opportunities to take that money outside the United States and invest it in other places like China and like Germany and France and any place else that they want to take their money. Spain, look at how much money was lent to Spain. Turkey, look how much money was lent to Turkey. Because the banks had that option. It was a bad one. But they did, so they took advantage of it, and they should have paid for that, but they didn't because they were too big to fail, and that's a fallacy in a free market system. In a free market system, if any entity has become too big to fail, it is no longer a free system, and that's not a good thing. I've tried to stress on this program in the past. A lot of my friends, and I am, a very libertarian type person. I believe the people have the right to choose, and so I'm a believer in the free market system to a large degree. I do believe in it. I believe in it 100%. But I believe in a free market system, and many of the markets that we're currently in are not free markets. Markets that are dominated by a handful of banks are not free markets on that side. When there's millions, literally millions of consumers, particularly small businesses on one side of the equation, and there's only a handful of banks, literally handful of banks on the other side of the equation to loan to them, what do you think the chance is that small business is going to get that loan at fair terms and fair prices and fair rates? Zero chance. There's no competition for them. They can dictate. The banks can dictate. And so, realistically, there's no chance that because that's not a free market system. That's a system that needs to be regulated. And it needs to be regulated. It can be regulated to freedom. It can be regulated so it becomes a free market bank, a free market system as much as possible. But it needs to be regulated to say, oh, it's, we need to leave our hands off it. That's wrong. It's not going to work. Now, if you're social engineering it, that's a different story. When I'm talking regulation, I'm not talking about, making it so that it accomplishes some social purpose. That purpose is Congress and the government. And if they want that, they need to vote it. And the local government needs to vote it. If there's an issue there, you want to accomplish some social purpose, which many of those social purposes are very, very good, like housing or whatever. You do that politically, working with the local markets and the local free market system to create a regulatory environment that allows them to produce products that you want. But you do not, you don't try to regulate that at the national level, because that produces really, really bad results. And it doesn't produce any more fair market. At that point, the government might as well just control. And that's, I guess, the kind of my point is that at some point, if you allow a market to deteriorate and you don't catch it, you allow it to deteriorate to the point that is no longer anywhere close to free, and it can't be regulated back to free, then, you have to have it under government control. There's just no way around it. And that's hard for me to say as a person who believes in the free market system. But at the same time, it's absolutely true from an economic standpoint. I mean, the economic definition of a fair price involves sellers and buyers on opposite sides of the equation with equal strengths. And if you don't have that situation, then you don't have equilibrium, which is where the buyers and sellers negotiate the price. Equilibrium is by definition a fair price, because equal strength sellers and equal strength buyers have determined what that price is going to be through negotiation in the market. And in that situation, you have a free market, you have a free price. But if one of those parties, if the selling side is much stronger than the buying side, you're not going to get a fair price. That's what's happening in the real estate market right now. And I've got a townhouse for sale, and I'll fully say that it's overpriced, but it's not overpriced based on the market, but it's overpriced currently in the market. And why is that? And what's the difference in that? Well, the difference is that right now there are not an equal number of sellers. The real estate market is as homogeneous and as diverse as you can get, and it's very, very, it's usually very, very much of a free market system, and it's very, it does produce, usually on a regular basis, produces fair prices, but sometimes it doesn't, and we have that situation in Martin County right now, and to some degree St. Lucie County and Palm Beach County, is that there is a limited supply. we have a lot of people now that want to buy houses in Florida and on the Treasure Coast in particular. We have people that are online from New York and from from Massachusetts and other places who are just buying properties sight unseen. So there's a ton of potential buyers. You have young families that are trying to get into a home before with interest rates low, and bingo, you've got you've got a situation where you've got tons of buyers and limited sellers. When that happens, price goes up. Price goes up beyond a fair price. Now, what will happen over a period of time is eventually the market will correct itself. It will either correct itself because a lot of people will say, you know what, I want to change houses. I want to downsize. I want to get out of my house. I know I'm going to pay a lot for the house that I'm going to buy, but I'm also going to get a lot for my big family house that I don't need anymore. And I could use that money for retirement. And so that's going to mean more people are going to put their home on the market. Some people are going to say, you know what? I don't know where this market's going. It's heating up too fast. I want out of my house. I'm going to get out of my house. I'll rent for a period of time, see what happens. And then you got some younger people that are looking at the market and are going to eventually fall out of the buyer side. They're going to say, you know what, this is too expensive. I can't afford it. Interest rates go up. It becomes unaffordable. And that'll quickly change the issue, because if interest rates go up, say 1 point from where they're at now, and we're in the twos now. We're in the twos now. If the market goes up even a point, 2 points, there'll be a number of people that can't qualify. So all of a sudden, boom, all of these buyers will go away. A lot of these buyers will go away, particularly first-time home buyers, and that'll bring the market back down, because now we'll have the same number of sellers, but we'll have less buyers, less people that can qualify. Frankly, if interest rates go up 3 or 4%, it will shut the market off. At that point, we'll have a problem, because nobody will be able to sell their house because there'll be a limited amount of buyers. And the only way they're going to sell their house is if they have to, and then they're only going to be able to do it by discounting the price. Why? Because at that point, there will be much fewer buyers that can qualify for a house in that price range. So, typically that has an impact on various price ranges depending upon what happens, particularly in that area of the first-time home buyer or the initial single-family home buyer. That has a big impact. So, I think that's something that we need to worry about is what's going on with interest rates, and something that we need to be concerned about. But my point is that the banks, right now are in, and the mortgage companies are in a situation that's a little unusual. You hear the banks talking about, again, talk about competition and regulation creating a lack of competition. Right now, you'll hear people say mortgage rates are fantastic. You need to go out and borrow money. Go out and borrow money on mortgage rates, and that's true. When I was if you're looking at investing in something, and here's what people don't think about. They say, "Oh, I'm going to buy this. I'm going to buy property, or I'll buy stocks, or I'll buy bonds, or whatever." They think of that as an investment. What people don't think about is that sometimes debt is an investment. And that sounds crazy, right? That sounds crazy. But let's say I've already got an asset, and I've got an asset that is potentially going to increase in value. It may be a stock, it may be real estate, whatever, and I'm comfortable that thing is going to increase in value, maybe to the rate, maybe at the point of, on average, 4 or 5% a year, or maybe for the next 10 years, I think it's going to go up 7 or 8 or 9%, because I believe that interest rates are going to maybe interest rates are going to, and inflation is going to be back in the market, and inflation will go up. And so at that point, the value of my property will go up. Now, think about this a minute. If the value of my property goes up, but my debt goes down in value or in cost, and that's what happens. So when interest rates go up, the value of your debt goes down. The cost of your debt goes down. So if I have $1 million mortgage on a piece of property and interest rates go up 10%, right? Interest rates go up 10%, then my debt, if it's a 30-year mortgage, for example, is going to go down in cost. If somebody was to sell it, it's going to go down. The principal value of it's going to go down by about, not the 10% interest cost, not that. If interest rates were to go up by 10 points, by 100 points or 1,000 points, so up 10 points, 10%, that's a different story. I'm talking about if the value of my real estate goes up by 10% and the cost of my debt only goes up by 10%, the interest rate goes up by 10%, which is not a lot. The value of my debt, the cost of my debt has gone down. Inflation will cause debt, fixed rate debt, to go down in cost. It becomes cheaper because it's being paid off with cheaper money. And so it is an investment. It is an opportunity to make money. And that's why, everybody's talking about these rates and should you go get it? Yeah. I mean, if you've got a situation like that, and, I look at it over the long term. When was the last time mortgage rates, any 30-year borrowing rate was under 3%? And I'm not talking about 15-year rate. I'm talking about a 30-year rate. When was the last time it was under 3%? I don't know if it ever was. In modern times, I don't know that it ever has been. So now if I'm saying, what's the chance I'm at the low end of the interest rates? I'd say it's pretty good. If historically this has never happened before, I'd say you're pretty good. There's a pretty good chance that you're going to, you've got the lowest rate you're going to possibly get. But in your lifetime and probably somebody else's. So if I've got an opportunity to lock that cost up and then use that money to invest in something that's going to go up in value, like potentially stocks or real estate or whatever, wow, that's a pretty good deal, right? Even if you look at it, although I definitely don't advise this for retirement, but even if you look at, you've got a house that maybe is worth $500,000 and you don't want to get rid of the house. You still need a place to live. You don't really want to downsize and still pay the same price for your house. Well, what do? Borrow against the house. Take that money, borrow against it, and then buy something. If you're going to buy something that's going to appreciate in value, and if we're talking about certain things being at historic lows, now I'm not sure real estate is at historic lows now. I'm not sure that hasn't already escalated in value, but there's other things that it may make sense to purchase. But there again, that's a big guesstimate. It's a big risk based on what could happen in the economy. So it's a situation where you have to be aware of where there are opportunities to make money and then opportunities to lose money, because both of those situations can occur. It's both pretty decent situations. But I will tell you that if I had an opportunity, if I look at, let's say, real estate right now, and you look at the real estate market and you look at the number of places that no longer allow you to rent your unit, and so you look at the amount of rental properties and you look at the cost of real estate in that end of the market, especially in the 55 and over groups, that there's still a pocket there where that's pretty cheap money. And then, a fairly cheap value cost. And then you've got, if I can get a fixed rate loan, that's not a bad deal. But I think that window is small because right now, there's 450 apartments coming online. There's 278 apartments coming online north of Stuart. There are already 200 and some again north of Stuart. We're looking at something. If it's all built, we're looking at something in the range of, probably something in the range of 1,000 units. They won't all be built. I mean, I know that some of these government people think that they're going to be built. That the person's gone through the process. They won't all be built. Some of them will stop because there is not the need for 1,000 houses, 1,000 apartments, small apartments in Stuart, Florida, and in this area. It's just not the need for that many housing units at that price range. So initially, what's going to happen? Well, what's initially going to happen is that the price of rentals will fall. So if you have a rental property, you better be able to rent it out for $700-800 because and still make money because that's where the market's going to collapse to. I think you can't put that kind of supply on a small market like this and expect that the market can absorb it. I think that the estimated absorption rate for Stuart was about 10 units a month. So how many months is that? 100 months is a long time. Is a long time to absorb product. That's not going to work. You go broke before that happens, or you just don't build the project. And that's what's going to happen. These guys are going to go through the approval process, and it's going to be, let's see who can get it done the fastest. And somebody's going to lose in that process. But once somebody loses, the first loser, the rest will all bail. The rest of them will never be built. So there's 1,000 units on the drawing board. Those 1,000 units will never be built. Pure economics. The market can't absorb 1,000 units. Price will go down. When price goes down, it makes those projects unattainable, makes them unaffordable. You can't make an investment. The investors will pull their money and won't go through it. Yes, they've sunk money into it. Yes, they have these sunk costs. But the fact of the matter is, there's no way we're going to get that kind of growth in Martin County that rapidly to cover the absorption of those units. So it's kind of foolish. I mean, I know some people think, oh, these, it'll make the housing affordable. No, it won't, because the housing won't get built is what will happen. And so it will make some places affordable because they'll get built and then they won't be able to rent them out. So they'll drop the rate. But what will happen is that those projects will go into foreclosure. They'll go into default. And so what you'll have is a piece of garbage. The houses will be in disrepair. The apartments will be in disrepair. Things won't be taken care of. The city can fine them all they want. The person, the entity that owns it is not a local guy, not some local person here. It's a group of investors that are just going to bail from the company. The company's going to go broke. There's no personal guarantee on it. These aren't personally guaranteed by some local investor or local person where they're behind their product and they've got to keep it up, and if they get fined, they got to pay. No, this is some large corporation that's just going to pull out, never going to see Martin County again, doesn't care. And that's what's happening. So that's one of the things that I think is on the horizon. And we've got this big push all of a sudden in the city of Stuart for high-rise apartments and tons of apartments. And I'm all in favor of housing, and I'm in favor of providing housing. But when you go to an extreme, like we're doing, like what we're approving, we're looking at an absorption rate that is not possible. So what it means is that those units are not going to be built, or if they are going to be built, they're going to be built over a number of years, 10, 15 years before you're going to get those things, before there's the absorption for them. So it's not anything that's going to happen anytime soon. It's not going to create jobs anytime soon. It's not going to create anything anytime soon. It's just going to be a phased development that's locked up and will just stay there for a while. Look at the property that's for sale across from the courthouse. It's gone through a number of owners, and me included, gone through a number of owners who have tried to do something there. But that property and that market there is difficult. It requires a certain timing. It requires a lot of capital, a lot of financing, and that market there just wasn't that kind of interest in Stuart for that kind of money. Now there is, but that market is all shifted towards residential, and it's going to overbuild because we're going to have too many sellers, lessors, and too few tenants. So anyway, one of the reasons I'm talking about some of this stuff is, we did have an election. I said I wasn't going to forget the elephant or the donkey in the room, and uh, and the bottom line is I'm not. And so the question is, what happens with this election? Well, like I started off saying, hopefully you didn't decide to guesstimate ahead of the election and sell something or buy something, because frankly, even right now, I don't think we have any idea. The market is trying to guess. They're trying to say, well, and I think in general, what you're seeing is that the stock market is feeling like the economy is going to do better if Trump is elected, and they're seeing some opportunity there. They were prior to the elections. I think they were feeling that maybe Trump was gonna get in. The market took a little bit of a runoff. Then there were some people hedging bets. I think right before the market turned. I mean, right before the election, I think some people hedged bets and sold out a little bit, so we had some losses. But I think that in general, the equity market was more comfortable with Trump. Um, I think on the debt side, I think that I think that the bond market was not comfortable at all with. I don't think it was comfortable at all with Biden, and the reason for that is that I think that there is some concern that that his programs are going to generate debt, and that debt is going to go be in competition with private debt, and that's going to force the interest rates up on private debt. And what happens, like I said earlier, what happens if the interest rate on debt goes up? If the interest rate goes up, the value of the bond or the investment goes down. So you lose money if you try to sell that investment. Um, you lose money if you hold it to maturity. You just lose it over a longer period of time. It's called an opportunity cost. So if interest rates go up and you have a bond with an interest rate lower than the current markets, if you sell it, you're going to take a hit. If you hold it to maturity, you're thinking, well, I got my principal back, no big deal. Yes, but you could have gotten your principal back plus, it's called an opportunity cost. You could have got your interest back plus if you'd have held on to, if you'd have gotten rid of it and bought something else at market, you would have recovered more than your money back, is really what it boiled down to. But it makes you feel better because you didn't actually have to take a loss. But in reality, that's what happens when you sit on an investment that is underwater. You're still taking the loss. You're just taking it over a longer period of time, and it's not recognized. So you're just not recognizing that you took the loss. You don't get to deduct it. So that's really what is happening, and that's the concern on the on to some degree both sides, but it's definitely the concern on the Democrat side is that interest rates will go up because the government will be providing a lot of stimulus, and that stimulus will have to be borrowed because government doesn't have $1 trillion surplus. And so we'll end up borrowing that money. And when we borrow that money, it will take money out of the private sector. And you can say, well, that doesn't make sense. I don't see that. Well, here, I'll give you a good example. Mortgage rates are down. Everybody's excited. Mortgage rates are down. Try to go borrow money, especially if you're a small business. The underwriting guidelines have changed. I'm talking about an individual who owns a small business. So let's say I want to borrow more money on a mortgage. And, I hear, interest rates are 2.75. Interest rates are whatever, 30-year fixed are 2.75. Well, first of all, that's for the best borrowers. Well, most small business owners don't have 800 or even 750 credit scores. Why? Because they have to borrow money in their business, and borrowing money in their business and the level of debt they have to run their business affects their credit score. It just does. That's why any of us that own small businesses know how to manage our credit and manage our credit score so that we can borrow at opportune times, because we know there are going to be other times when our credit score is going to be garbage because we've had to leverage up for something. We've had an unexpected expense in the business. We had to borrow money to take care of it or whatever. We're going to have our credit cards up because we've got a lot of, items that we've had to put on credit just for a short term. Maybe they're materials we're buying for expansion or whatever, but we have to use our credit card to do that. That causes small business to have lower than a perfect credit rating. It is very hard to maintain that kind of high credit score all the time. So first of all, I'm not getting 275. Now all of a sudden, I'm over 275. Um, what if I don't have 20% down? Well, I'm going to get dinged on that. I'm not going to get as low a score if I don't have 20% down. So, and now what they've added to the mix, and this is kind of just ludicrous on the residential side, is that if you have a business, they want to see your current year financial information. They want to see your current year financials. Well, uh, first of all, a residential underwriter has no clue about underwriting a commercial business. They have no understanding of what's involved in that. They don't do that for a living. They don't analyze that for a living. And so the first thing is there's nothing good that can come from a residential underwriter asking for my business's tax information or my business's financial information, particularly the financial information, which hasn't been adjusted for year-end adjustments, hasn't been taken care of for tax adjustments that occur at the end of the year. So they're not going to understand that. They don't understand the methods of accounting, gross profits. They don't understand, accrual versus cash. They don't understand all of that stuff. They just don't. That's not their job. So, but now we've got them looking for it because all of a sudden Fannie Mae and Freddie Mac have decided that, well, we need to see how they're doing this year because of the pandemic. We're not loaning anybody money unless we see how they've done this year. Well, last I looked on a 30-year loan, if all I'm concerned about is 1 year of the 30 years, I'm probably being stupid. And the best way I'm going to know about whether or not my client has the ability to pay is have they historically paid and what's their historic income been? Because that's pretty much what I'm going to be looking at. Otherwise, what am I going to do when the next situation occurs? What happens if we have a pandemic 3 years from now? Am I going to go back in and ask to see their financials again so I can see what's going to happen? No. The question is, what are they doing now? What's their credit now? What have they done? To get in and start underwriting a commercial entity for a residential mortgage is ludicrous. But why are they doing it? Because they can. There's very limited companies. There's only Fannie Mae, Freddie Mac, and FHA, VA that is loaning money long term. So they have the market. They can say whatever they want, and they do. That's called regulation, and that regulates the fair market. So what they're doing is regulating out small business from the residential mortgage market. They're making it much, much more difficult for them to borrow money. Crazy, crazy stuff. But that's what's happening, and it's going to continue to happen. It's the same thing that happened on the PPP side when we had the loans on the PPP side. What happened there? The big banks jumped in because they were too big to fail, and they still exist. So they jumped in, and they took over the market, and they skewed and pushed all of that money to their larger borrowers, and the small business had to wait. In fact, it was so ridiculous that many self-employed people had to wait a week after the other businesses to be able to even file an application, and by the time they got ready to file, they were told there wasn't any loans available, or that they didn't qualify, and they did. but anyway, they changed the rules and the money was gone. So that's what's going on. It's, you got to look behind some of this stuff. So you hear these things, and mortgage rates you hear are at historic lows. Are the loans that are being made at historic lows? No, because on average, those rates are going to be higher. Are investment loans being made at those rates? No, they're not. They're higher. Are loans with 3% down being made at those rates? No, they're higher. So the bottom line is that are loans to small business owners being made at those rates? No, they're not even being made many times. Or if they are, they're being made or over a longer period of time or lesser money down. You have to have 30% down, 25% down instead of 20. And that means a disadvantage for you as a small business if you need that money. So that's what's happening. And so the question becomes, what is going to happen going forward? And I think that no matter who wins, Trump or Biden, no matter who wins, there's not going to be a winner because this economy is in a very difficult shape economically, and it's hard to grow out of $1 trillion, and that's what it's going to take. And we have an awful lot of debt. So we're looking at one of two things coming up. I think we're looking at a crash that actually corrects the market. We didn't do that, and we didn't correct a major portion of the market. It's one thing to save auto manufacturers. Who cares? That doesn't make that big of a difference in the economy. Sure, we lost a bunch of jobs to China, but and other places. But the financial market, we've lost the financial market. The financial market is out of control, and it will continue to be out of control. And until it is corrected by those guys going out of business because they make stupid mistakes. When you loan $1 billion to to Spain, and then you lose it, you should pay for that. None of those banks paid for that. None of those big banks paid for that, and they should have. They shouldn't even be around today. They shouldn't be asking to see your financial statements today. They shouldn't be asking for any of that stuff. They should be gone. They shouldn't have been involved in the PPP loans. They should have been gone. But now they're there. They're big competitors. They have a significant advantage, and the littler banks are being forced to merge and go away. And so we have no competition. You cannot have a good economy going forward if the significant source of your capital and loans has absolute control of the market. And that's what we have today. And I don't know that you can unregulate your way out of it, because unfortunately they're so big. The only way that happens is that they go out of business, and that didn't happen. And they're probably going to have to. The alternative is that we see rampant inflation, and the value of everything goes down, because inflation pushes the value of anything that's fixed in value down. So, it's going to cause a problem. What happens? Well, next week we'll talk about that. Hopefully we'll have most of the election results by then. Probably not, but we'll talk about that and maybe have some ideas as to what you might be looking at in an economy that's driven by Biden, or an economy that's driven by Trump, or what the opportunities are there. So anyway, join me here on Treasure Coast Solutions. Again, every Wednesday, 9 to 10 o'clock, right here on WSTU Digital 1450. And we'll have some information that hopefully you can use in your day-to-day life.